relationship. Let's move on. Let's talk about Transrail lighting then, the very first management on the show. Joining us now, Randeep, Narang, who's the MD and CEO of the company. Obviously, the discussion will be around the new order win that the company has made in Middle East, North Africa rather. They've said that they're on track for 22 to 25% growth in FY26 on the top line. Let's see where that goes. And strong execution order and timeline. Will that momentum continue or not? Thanks a lot, Mr. Narang, for joining in. A good order win that you've got, around 550 crore rupees. But in light of your overall book of, nearly 9,500 crores as an order inflow for this year, it's not moving the needle much. It's just about 5.5% of your targeted order inflow. What I'm curious to know about is the first half of this year, you've done a 61% jump in your revenue and a near 50% jump in your EBITDA. You're still maintaining this 22 to 25% sort of growth target for the full year. Why is that? Do you expect some slowdown in the second half? Or do you believe that you will outpace the guidance that you've given already, given where you are at the first half of this year?
So hi, thank you for having me here. So the actual revenue depends on the state and the quality of the project management focus. So some projects are into engineering approval stage, some are into execution stage. However, we had set a guidance of 23 to 25%, but we are confident that we'll cross 25% plus. And that's the change we're seeing now. Post monsoons, our execution is getting better and picking up faster. So we are confident that we will beat this guidance of 25%, definitely by a percentage point or two.
Okay. Well, Mr. Narang, if you could just give us a sense in terms of what kind of cumulative order inflow are you expecting in the second half of the year, and where exactly would it be from sector-wise?
Okay. So principally, we have around 15,000 odd crores of unexecuted order book and around 2,600 crores of L1. We have booked orders worth 3,700 crores this year so far, and a L1 of 2,000 odd crores, 2,600. So we are around 6,000 crores of fresh orders. We are looking at another 3 to 4,000 crores of new orders in the next 5 months. And we are on track for that. And our bidding pipeline is there. We're looking at bidding at least 30,000 crores of new orders in the next 4 to 5 months. So we're pretty much, our guidance stands stable and it is in line with what we promised.
All right. So you are on track for that 9,500 to 10,000 crore worth order inflows this year itself. What about the margins? You said it depends on the quality of the execution that you're doing, the quality of the client, etc. You have been guiding an 11.5 to 12% sort of margin range. First half of this year, you've managed to hold on to that 12% mark. Just the way you are going to outpace your guidance on revenue, will you do that on the margins as well?
I think 11.5 to 12% is the steady state we are looking at. Of course, there are some projects which are lower, some are higher. So we are looking at a balanced portfolio of margin management. We believe that 11.5 to 12 is a very stable margin profile, much better than our competitors. And we are therefore focusing to make sure that this happens. And we are pretty confident that we'll maintain it.
Okay. Well, Mr. Narang, you're confident in terms of your revenue as well as your margins. Just wanted to understand what you are doing when it comes to the international business, because you have 2 projects in Bangladesh, we do understand. Totally, I think it's around 30% of your total sales. Give us a sense in terms of the incremental order inflow, how much of it is coming from the international business, and are margins significantly different from, say, the domestic business?
So our current order book is around 60-40, 60 domestic and 40 international as we go along in terms of including the L1s. What we believe is that we will maintain that the India market is booming, the T&D industry is booming in India. And international also, there is a steady growth in Africa and other countries. So what we believe truly is that the margin profile has improved in India and international both. And therefore, we are in that good zone. You also know that we are well diversified backward. We are into towers, conductors, tower testing, making monopoles. So we have a very strong cost structure, execution skills, and diversified backward integration. So that helps us to maintain a margin profile.
Right. Speaking about the margin profile itself, I just wanted your thoughts on 2 things in particular. One, In the second quarter, there was a big jump in your subcontracting expenses. If you could tell us what explains that and where is that likely to settle as a percentage of revenue? And the second part is the brownfield expansion, which is coming on track in the third quarter. How much will that support your operational performance, given that it will be more backward integration in nature than revenue recognition?
Yeah, so that's a good question. I'll answer the second question first. So the backward integration on our brownfield projects is on track and will be in stream by December, that is next month. Our new factory, which is for towers, a greenfield project, will be operational. It's already started slowly moving into the production planning, production startup phase, and by January, that will also come into being. A conductor factory will happen by June, July of next year. So we're very much in line with our projections for supporting our revenue growth through our backward integration of factories of towers and conductors. Now, on your assets part, what you mentioned, we are particularly looking at higher execution happening. And as revenue is growing, there is also a certain amount of retention cost. There's a certain amount of inventory buildup, which is temporary and which will ease off by March. So we already focused on that, and that will be closed and controlled by March.
Okay. All right, Mr. Narang, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Transrail Lighting. They have increased their guidance in terms of the revenue. They're expecting around 26 to 27% growth versus 22 to 25% that they anticipated earlier. And they are also expecting the margins to be stable at around 11.5%. We'll take a short break, but up next, we'll focus on the markets. Pankaj Tibriwala of Ikigai Asset Managers will join in to discuss the markets. Stay tuned.